Good day to you and welcome to another Paddocks Club tutorial. Today I'm going to give you a quick overview of sectional title insurance. The first heading is Reinstatement and Replacement Insurance. All bodies corporate must take out insurance for the full replacement value of all the buildings and improvements on the common property. This covers the cost of repairing or rebuilding, replacing the damaged property and removing debris, as well as paying for architects, builders and other contractors required in the process. PMR 29.1 deals with the details of this indemnity insurance. When you look at getting valuations for the purpose of figuring out what is replacement value, the issue becomes who should give you such a valuation. An ordinary property valuer? Well, there are some that would argue that the profession qualified to give you a proper replacement value are quantity surveyors, and that you shouldn't really get a valuation from an ordinary valuer. Well, I think it depends on the circumstances. The more complex the structure, the less one can rely on rates per square meter published in standardized valuation publications and the ordinary extent of the expertise of a valuer. So if you have a complex scheme that has lifts and is perhaps high stories, this sort of thing, then perhaps you should be going to a quantity surveyor. In other cases, perhaps an ordinary property valuer might be able to do the job. Certainly, the quantity surveyor will probably be more expensive. But once you've got a reliable valuation, this should be shared with owners as part of the process of agreeing both the overall insurance amount and the amount allocated to each individual unit in the scheme. Let's move on to public liability insurance, dealt with in PMR 29.2a. The body corporate must take out liability insurance for to a minimum of 100,000 rand for damage or liability arising from an obligation to pay compensation for the injury, death or illness of a person, or damage or loss of property arising from the common property. Well, 100,000 rand today doesn't seem like a lot of money, and I can imagine that if in a lift accident 5 people were hurt, by the time you finished with medical and legal fees, you would be way past 5 or even 10 million rand. So I think a sensible amount in the circumstances, particularly to the scheme, should be looked at. This is something that should be on the AGM agenda every year. Let's move to Fidelity Insurance, dealt with in PMR 29.2b. This is only required to the extent, if any, determined by members in general meeting. So whilst it is relatively cheap and I think very sensible to have it, it's not obligatory to have Fidelity Insurance. PMR 29.3 deals with other insurance. So the body corporate can, by special resolution, decide to take out any insurance that it considers is important to safeguard the interests of the individual owners. So you might get trustees' liability insurance. You might get machinery breakdown or catastrophe insurance if you happen to live in an area where there could be a natural catastrophe. You can get legal defense insurance, so therefore insurance for the expenses involved in legal defenses. A type of insurance which I haven't seen before but think would be sensible would be a guarantee insurance of some sort, which the body corporate requires any owner who extends their section to take out, so as to give the body corporate cover for the costs associated with maintaining that additional and new common property created in the process of extension for, let's say, 3 to 5 years. But the body corporate should seek professional advice about the range of insurance products it needs and how much it needs in each case. Again, I repeat, the range and amounts of insurance should be on the agenda at the annual general meeting. We can discuss this further in the discussion forum. Thank you.